So here's the question we're digging into. How can 65 massive U.S. car dealerships just vanish
Yeah,
overnight,
yeah.
triggering a $200 million federal fraud probe and leaving thousands of hardworking people suddenly jobless, just scrambling for their last paycheck?
It's catastrophic.
This isn't just some headline you skim past. This is it's a complete collapse with very immediate, very real-world consequences.
Mhm.
The auto retail world was just rocked this week by the abrupt shuttering of all these dealerships under the Tricolor and Ganas Holdings umbrella.
It wasn't a slow decline, was it?
Not at all. This wasn't a bankruptcy you see coming for months. This was a detonation.
Right.
We're talking about 65 locations, doors locked, no warning. It sent shockwaves through the used car market, not to mention the local economies that, depended on them.
The scale is just staggering.
It is. A $200 million fraud probe is now active, and reports suggest something like 80 to 90% of the workforce was furloughed. Just like that.
Thousands of jobs.
Thousands. And a lot of those folks are still waiting for paychecks they are legally owed. And look, this company, they operate in the subprime auto market, which is already under pressure, right?
Sure, with interest rates and tighter lending.
Exactly. But when you see a failure this sudden, this systemic, it's not just market pressure. It's a deep structural rot.
It'd have to be.
So our mission in this deep dive is to get past those headlines. We're going to trace the money, specifically how this financing tool called floor plan lending,
Which is key to the whole industry.
absolutely key, how that combined with just profound, almost inexcusable failures in banking accountability, allowed a fraud this massive to just flourish.
And to really grasp this, you have to look past just one or two bad actors and focus on the systems they were able to exploit.
Right, this isn't a one-off.
Not at all. We're tracing a very predictable and very costly pattern here.
Yeah.
You've got lax financial controls, institutional complacency, and a moral hazard that ends up compromising the entire system.
Leaving the community and often the taxpayer to clean up the mess.
Exactly. So we've broken this down into three parts for you. First, we'll get into the architecture of this inventory finance and its built-in flaw, something called selling out of trust.
Okay.
Second, we'll dive into the sheer audacity of the deception. I mean, the costume jewelry fraud is almost unbelievable.
I can't wait to get to that one.
And then finally, and this is crucial, we'll look at the systemic accountability failures inside the community banks themselves, the very institutions that were supposed to be guarding the capital.
Okay, let's unpack that first piece then, the foundation of this whole industry. What exactly is floor plan lending?
It's the absolute lifeblood. Without it, the dealership model just doesn't work.
So it's how they get the cars on the lot in the first place.
That's it. Think about it. The dealership needs millions of dollars of inventory cars, trucks, just sitting there waiting for a buyer.
Right, they can't pay cash for all that.
No way. So floor plan lending is a specialized revolving line of credit that lets the dealer buy all that inventory without using up all their cash. It's essential.
I think the best way to visualize it, based on what we've read, is that consignment shop analogy. It really clarifies who owns what.
That analogy is perfect. You should keep it in your head. The bank is like the wholesaler, but they hold the deed.
So the bank actually owns the car.
The bank owns the collateral, the vehicle, until it's officially sold to a customer. And that leads directly to the core rule of this whole system.
Which is?
The loan has to be repaid from the proceeds of selling that specific car.
Okay, so if the bank fronts the dealer 40 grand for a blue sedan, the dealer sells it for, say, 45. The moment that sale closes, that 40 grand has to go straight back to the bank.
Immediately. To retire the loan advance against that specific sedan, it's a direct one-to-one obligation. The loan and the car are tied together.
Which protects the bank, in theory.
In theory, the system works great as long as the dealer is, well, honest.
But that setup creates one massive fundamental vulnerability, doesn't it? It all hinges on the dealer actually doing that last step.
It does. And that vulnerability has a name. Selling out of trust, or SOT.
And this is where the whole thing collapses.
This is the moment. SOT is when a dealer sells the car, but instead of sending the bank its money back, they divert it.
To do what?
Rent, make payroll, cover other expenses, or sometimes just outright embezzlement.
Hold on. So the bank is just trusting a dealer they've loaned millions to call them up and say, hey, I sold your car, here's your money. How is that a secure system?
Because the industry is built on speed and volume, the bank thinks its risk is covered by doing periodic inventory checks.
They send someone to the lot to count cars.
Right. But when SOT happens, the damage is already done. The bank's books say they have a loan secured by a car on the lot, but that car is actually in some customer's driveway, miles away.
So they're left holding an unsecured loan with no collateral.
Exactly. The asset is gone, and the cash that was supposed to replace it was used for something else.
And this happens when a dealer is in trouble.
Almost always. The source material is clear on this. SOT is a sign of a critical cash flow crisis. The dealer is basically using the bank's money as a secret short-term loan, hoping they can sell another car before the bank shows up to count.
It's a spiral from a cash flow problem to a financial crime.
A very fast spiral.
Okay, so this is where the story gets really wild. Because it's not just about hiding sold cars. The Hallman Chevrolet scheme, this shows how you can manipulate the system before the car even moves.
This one is just a masterclass in moral hazard. Hallman Chevrolet defrauded its lenders using a method that is, frankly, almost laughable in its simplicity.
Which was?
They coached their customers to bring in costume jewelry to use as a down payment.
Wait, costume jewelry, not diamonds, not gold watches.
Nope. Cheap, worthless baubles.
That's staggering. How do you fool a bank with that?
It's all in the paperwork. The dealership would take the cheap jewelry, tell the customer their down payment was covered, and then they just lie on the bill of sale and the bank contracts.
They wrote it down as a substantial cash down payment.
Exactly.
Right.
And that lie was designed to make the lender think two things. One, that the borrower was more creditworthy than they were.
And two, that they had skin in the game, that they were financially invested.
Precisely. A lender sees a down payment and thinks, okay, this person has an incentive not to default. But it was a complete illusion.
The financial institution was unknowingly funding the entire cost of the car.
100% of it. The customer often walked away with zero personal investment.
And the consequence of that lack of investment must have been devastating for the lenders.
Oh, absolutely. It's a double whammy. First, the bank now has an under-collateralized asset. The car loses value the second it leaves the lot, and the bank loaned the full price.
So they're already underwater.
Immediately. And second, and this is the bigger problem, they were lending to very high-risk people who had no reason to keep making payments if things got tough.
So what did that do to the default rate?
The fallout was immediate. The loan default rates for these fake down payment deals were over double the industry standard. And this one scheme cost the financial institutions over $1 million. It's the perfect example of how a simple illusion enabled by a lack of basic verification leads directly to mass defaults.
Okay, so if we connect that, the jewelry scheme and the $200 million collapse, the question is still, why didn't the banks see it coming?
Right.
Faking down payments with jewelry sounds like, basic fraud 101. Why does a crisis this big still happen so suddenly? The problem can't just be the dealers, it has to be inside the banks.
You've hit the absolute core of it. The real issue is institutional complacency, and you see it a lot in community banking.
And these are the banks providing the floor plan capital.
They are. And our sources point to this alarming pattern. 4 banks have failed in the last 4 years.
Yeah.
Pulaski Savings, Santa Ana National, Heartland Tri-State, and First National Bank of Lindsay. All of them failed specifically because of inadequate internal fraud controls.
And when a bank like that fails, who picks up the tab?
The FDIC's Deposit Insurance Fund, which is taxpayer-backed. The cost for those 4 failures averaged a stunning $37.5 million per incident.
$37 million.
And it all comes back to these internal non-complex breakdowns. The sources point overwhelmingly to 2 things: concentrated executive power and relying on trust instead of verification.
Let's break those down. What does that first one, management override, actually look like?
Okay, so that's failure point 1. In smaller banks, a senior leader, maybe the CEO, often has the authority to just bypass the rules.
They can just ignore their own bank's protocols.
Or pressure other employees to. The classic example is Heartland Tri-State Bank. The CEO wired $47 million for a crypto scam. He did it by basically intimidating his employees into skipping the very controls designed to stop a transfer like that.
When the person at the top is breaking the rules, the whole system is broken.
It's guaranteed to fail. And that brings us to failure point 2. Board passivity.
The people who are supposed to be watching the CEO?
Exactly. But too often, community bank boards are just rubber stamps. They don't have the expertise or, frankly, the will to challenge management.
And the pressure to perform makes it worse.
Much worse. We saw one case where a bank president literally altered the minutes of a board meeting to hide loan losses because he was afraid he'd get fired for not hitting his income targets.
Unbelievable. And I have to imagine this gets even worse in this specialized world of floor plan lending, which is all about local relationships.
It absolutely does.
Yeah.
That's failure point 3, the trusted borrower trap.
Mm-hmm.
Relationship banking can be a good thing, but here it becomes a massive vulnerability.
Lenders go easy on the local big shots.
The rainmakers, exactly.
Mm-hmm.
We found a documented case where a bank president refused to fire a high-revenue lender even after repeated internal audits flagged huge problems with his loans.
Why?
Because he was a key revenue generator. They pushed short-term revenue ahead of long-term stability.
They chose to trust a person over their own verification systems. Which brings us to the final and maybe most basic failure of all.
Failure point 4. Inadequate verification protocols. It's so simple. Fraud loves predictable, minimal audits.
Right.
With selling out of trust, the only real defense is to physically verify the cars are on the lot.
Go count them.
Just go count them. But in one major loss, a bank let a huge dealership just fax them a list of their inventory for an audit.
They faxed it. They took a dealer's word for inventory worth millions of dollars.
It's negligence on an unbelievable scale. Effective risk management has to include unannounced surprise physical visits. Without that, a dealer can hide sold cars all day long.
If you can't verify the asset exists, you're not lending anymore. You're just gambling.
You're gambling with the bank's capital and eventually with the FDIC's money.
Wow. This has been a really powerful deep dive. We started with the shock of a $200 million fraud, and we learned how this whole system of inventory finance creates that trust vulnerability. We saw the absolute audacity of the costume jewelry scheme, simple manipulation that leads to double the default rate. And then we trace that financial rot right back to these systemic failures.
Executive override, passive boards.
And just shockingly lax verification inside the institutions that are supposed to be protecting the money.
Yeah.
I think the key takeaway for you, the listener, has to be this. The system's designed to protect our money. Things like segregation of duties, independent audits, board oversight. They're not being broken by some complex cyber attack.
Yeah.
They're being sabotaged by a simple lack of personal integrity and deep institutional complacency. And when that fraud finally detonates, it's the local communities and ultimately the taxpayer who are left to absorb the cost of that failure.
And that failure is what's so galling when you look at the economics of it. The sources we looked at show that setting up strong fraud controls, real audits, good training, solid internal systems, it costs less than 2% of the average failure.
2%?
We're talking about spending maybe $200,000 to $650,000 a year to prevent an average loss of $37.5 million to the FDIC. Which leaves us with a really important question.
Yeah.
In a world where basic financial accountability is so demonstrably cheap, why do these institutions repeatedly prioritize trusting unchecked relationships and high-pressure growth over verifiable systematic integrity? It suggests the industry fundamentally misunderstands what truly makes it strong.